All companies are required to report some type of equity statement that shows the changes in the value of your company during the period and why that valuation changed. For most companies nowadays, that is done via a statement of stockholders' equity. IFRS requires this, so every other place in the world will have a statement of stockholders' equity. GAAP technically doesn't. It allows companies to use different formatting for their equity statement. But in a weird twist, the SEC does. And the SEC has oversight over all publicly traded companies, which means that technically, if you are a company big enough where you have to meet GAAP standards, you don't need to make a statement of stockholders' equity. But if you do wish to sell shares of your stock on the New York Stock Exchange, etc., then you will have to produce a statement of stockholders' equity. Weird kind of thing over here. So what is this? Well, it's just a change in the company's value over a period of time. So how could a company change its overall value? Well, they could bring in additional capital by selling ownership, selling common stock or preferred stock, and you'll have some additional pickup in there as well. Money comes into the company, huge chunks of capital by selling ownership of your company to the public. The company can be profitable during the period and hold on to those earnings, which makes the company more valuable. So, retained earnings is a portion of the increase of your business's valuation. Distribution to owners, that's taking money out of the business and giving it to your owners. That's dividends, that decreases the valuation of your business. This is a withdrawal to be dispersed to your owners. Comprehensive income, while you've not yet realized it right now, it's still a component of your company's value. Those things that are in your AOKI, if you will eventually lead to a change in the value of your company, and you can have them listed on your statement of stockholders' equity. Also have treasury stock and also have that equity attributable to non-controlling interests. Your company might have a certain value, but if you have a minority holder of one of your subdivisions somewhere, not all of that value can be given to your stockholders. So a portion of your company's value might be entitled to a non-controlling interest somewhere. And on a statement of stockholders' equity, you are going to break down the change that your company had in equity and value during the period according to what sources it came from. All of these things that are listed here. For us over here, what's the format of every equity statement? 'Cause it's always the same. You start with what your equity was at the beginning of the period, and you add to it any additions that would increase the value of your business. So that would be your net income that you had during the period, any other comprehensive income that raised your profit, your valuation during the period would give you your comprehensive income. And then what decreases the value of your business, taking money out of it to give it to your shareholders. So your dividends declared in that case. All of these items are going to be thrown up in this document to show the breakdown of how your company's value changed during the period. So let's do an example right here because it's easier to just put it into practice. We're Starling Corporation, and we're starting the year on January 1st with the following. We're retaining $876,000 worth of earning profits that we made in the past. Up until this point, on January 1st, when we started this accounting period, we had raised um, a bunch of money from issuing stock. These shareholders that we have paid $100,000, which can be attributed to the par value of these shares that they purchased, but they paid $342,000 above that. That's our additional paid in capital. And then we have something on our books, which has been sitting there, which at some point is going to increase our income by 17,000 at whatever point we actually get to realize that. In this case, I'm going to assume some kind of unrealized gain. So Starling has these items on their books. Well, during the period, here's what happened. We had an unfortunate period where our company lost $29,000. We also took $5,000 out of the company to pay it to our shareholders. But we did manage to bring a bunch of capital in because we issued 20,000 shares of common stock. And as a reminder, that is $1 par common stock. But we issued them for a total of $400,000. We had pension costs of $12,000 net of tax. We have an unrealized gain on an available for sale investment, net of tax of 68,000, and we have an unrealized loss in this case on a foreign currency translation adjustment of 34 grand. So these are all items that either have actually changed the value of our business, these guys up here, or they will, these three components of Aoki down here. This is the format that we're going to have to fill in for a statement of stockholders' equity. So you start by on the columns listing all of the components of your equity, all of the different things that you could have value in the business from. Start with your beginning balance of all those accounts. And then for all of the items that changed it during the period, you make a separate row for that item. So filling this in, what is our company's stockholders' equity going to look like? Well, for starting over here, we started with those numbers that we had a minute ago. We had $100,000 of common stock on our books. That was the par value of shares issued. We had $340,000 of additional PIK that people paid in above that par value. We were retaining $876,000 of earnings, and we had accumulated other comprehensive income of $17,000. So all in all, our equity was $1,335,000. That was the value of our business when the period started. Well, we had a net loss of 29,000. Net income always gets closed as retained earnings. Net loss would as well. So our net loss is going to decrease the amount of money we have to retain by 29,000 and therefore reduce our overall valuation by 29,000. We paid $5,000 in dividends. Dividends get closed to retain earnings as well. So those $5,000 in dividends, we didn't retain. They have to decrease our retained earnings by that amount and also would decrease the value of the business by that amount. We issued $400,000 worth of stock during the period. There's 20,000 shares with a $1 par. So the total par value of those shares issued was $20,000 and increased the common stock. But our new shareholders paid $380,000 in excess of that par value. So that'd be an increase to additional PIK. For other comprehensive income, we had those three different items in there. We had some unrealized gains. We had an unrealized translation adjustment loss. We had unrealized pension costs at the time. All three of those added together come up to $22,000 of increase to our income when all of those events become realized, which will increase the value of our business by 22 grand. And down here for the balance, well, it's just taking whatever your beginning number was and accounting for all of the adjustments that you had in the rows that you listed below. So common stock started 100 grand. We issued another $20,000 worth of par value in common stock. It's now 120,000. We had $342,000 of additional PIK. That stock issuance we had during the period resulted in $380,000 of additional paid in capital coming in. 342,000 plus 380,000 is $722,000. So on and so forth. So now we have our ending value at the end of each period. And as we see when this year ends, our company has a total valuation of $1,723,000. How did we come to arrive at that value? Well, this amount of money combined came in from issuing shares. This amount of money, our retained earnings, is how much past profitability we're still holding on to. And accumulated other comprehensive income, this is the amount that maybe we haven't realized it yet, but it's going to happen at some point, and therefore it is part of the value of our business. And all in all, we now have information that our users can use to figure out, okay, did the value of the business change during the period? And the answer is yes. And we went from $1,335,000 up to $1,723,000. Business getting more valuable is good. But why did it increase? Did it increase because we were awesome and we made a ton of money during the period? And the answer to that is absolutely not. We took a loss during the period. Did it increase because we have some huge spike in our Aoki that we're waiting on, some pending massive increase to our profitability? It went up, but I wouldn't say $22,000 is a huge number. Why did the value of this company go up so much during the period? And the answer is right here. We issued a new round of stock. And it looks like we got a pretty good price for it because there's more pick off of 20,000 shares than there was 100,000 shares above, but still, we can't continue to issue stock over and over and over again. Our value of our company is increasing because people outside our company right now are paying us in money. We'd much rather have it be that the value of our company is increasing because we have some massively profitable operations. So a statement of stockholders' equity gives a better breakdown to use your information of how is the company changing? Is this something that's going to be sustainable in the future? And comparing it period to period in this case, is this something that's trending in a positive direction? So here is a more detailed one for Kimberly-Clark Corporation. This one also includes the number of shares that are outstanding, but it's the same basic concept. We have the balance that this company had at the end of 2017. It was the common stock that was issued and how much money they got from it attributable to par and how much money they got from it that was paid in on top of par, their additional pick. They've got treasury stock, so common stock they bought back from the public, how many shares they currently own. What is the value of those shares? That would be a negative because if the company owns those shares in treasury, the value of it doesn't get to go to the stockholders. To if we had to disperse profits, we have our retained earnings that we started with. We have the balance of our AOK account. We have the amount of money in here of our equity that's attributable not to our stockholders, not to our shareholders, but to this non-controlling interest. And then going down, we have the same items that we were talking about earlier, or similar items. Our income during the period, our changes to our comprehensive income, any stock-based awards exercised or vested means shares that we distributed to our employees probably as a bonus during the period. Shares that we repurchased, common shares we bought back from the public and put into our treasury. Uh, any type of recognition of stock-based compensation that came in, the dividends that we paid, and then if you don't know what to call it, as long as it's not a huge number, you can get away with other. But you can still see over here that Kimberly-Clark Corporation went down in value during the period. Why did it go down in value during the period? They were super profitable. Well, the answer is, in my opinion, right here. This company paid an absolute mountain of dividends, some of them to our existing shareholders and some of them to the non-controlling interest. So Kimberly-Clark looks on the surface like they made a ton of profit during the period, but their value didn't go up. And that's because they're paying out so much of their profitability instead of retaining it.